yields, 12 trillion of bonds globally, sovereign bonds with negative yields. And so the message, regardless of what you think about the next 6 weeks, the next 6 months, we're probably going to be, we investors, in a low interest rate climate for many years to come. In fact, we would project that the European Central Bank, the highest its policy rate will go at any time in the next 5 years is 0, and same for the Bank of Japan. So the Federal Reserve, perhaps it will lower interest rates as insurance against some of the risks associated with trade uncertainties, et cetera, et cetera.
Perhaps? Doesn't it have to with the bond market pricing
the odds
in this way?
Have increased, but there are events at the end of the month, as you know, in Osaka, Japan. The G20 holds the first ever meeting of the G20 in Japan, the 28th and the 29th, that could well hold the keys to what's next with the Fed. So it's not a done deal, and markets are priced for a lot of rate cuts, 4, you could say, in the next year. You may not get them, but regardless, the rate climate will stay low, most likely.
Let's dive into that. They're pricing for 4, but when are they expecting them to come? Because the equity market may be disappointed if it doesn't come until much later this year.
The market has greater than 50% odds there will be a rate cut in July. Almost 3 rate cuts priced in for this year and 4 over the next year. So there's a lot of weight put on the Fed's shoulders. It's a Herculean task, Atlas, in terms of lifting markets up based on that view. But if it turns out, as Mike said, is some other factor perhaps that drives rates higher, there is a little bit of room for rates to go up without unnerving equity investors. It just depends on what causes it.
So dare we ask, I mean, because it's been wrong every time we've asked before, have we seen the bottom for yields in the U.S.?
U.S. interest rates could collapse towards 0% in the next recession very fast, because what you'll likely see is the Federal Reserve commit to keeping its interest rate low until the jobs rate falls back toward full employment when the unemployment rate rises. The markets will presume it will be 4 to 5 years at least for that to happen, and that means most yields out to 5 years will be pinned near 0, just like you see in Europe, just like in Japan.
That's for recession.
That's a what if, and that's what's the lesson for investors. They should not look away from bonds simply because yields are low, because as a hedge against riskier assets, equities and credit, there's still a lot of potential for yields to drop. We're not saying to make a bet on that, but if you want protection against that, there is a potential for a big drop in yields when that time occurs.
Mike, to round it off, what happened to credit today and what happened to the VIX today, and what does it say about
credit was well bid today, so you did have that fit right in with the equity markets rallying. So interestingly, the volatility index was very stubborn. It only went down to a little above 16. It seems as if the options traders are going to kind of believe the new highs when they see them and not going to buy into this move necessarily being an up and away type of event. So it could just mean that there's event risk out there, right? You have a Fed meeting, you have obviously the G20, so maybe no need to kind of drain away all that protection.
The other big story today, merger Monday, United Technologies and Raytheon to merge in an all-stock deal. The combined company to be named Raytheon Technologies. It would create the nation's second largest aerospace and defense company behind Boeing, plus Salesforce set to buy Tableau software in a deal valued at $15.7 billion. Salesforce CEO Mark Benioff will be on Mad Money tonight with Jim Cramer, 6 p.m. Eastern. Don't want to miss that. Let's discuss these deals. Michael, of course, is with us as well. Michael, is there a common theme behind both of these otherwise pretty different deals, or are they just stock specifics?
Well, I think there's a common theme that, the merger mania is approaching the markets again because top-line revenue growth is hard to come by without mergers, for one thing. And then on the other hand, you've got active investors and analysts who are pushing companies to make moves to grow, particularly in a stock market where there's no assurance of being able to grow stock price without making major moves.